This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions. What if I told you there's one candle, just one, that shows up right before some of the biggest reversals on the chart? Not a complex three-candle pattern, not a setup that takes weeks to form, just one single candle. It's small, it's subtle, and most traders either ignore it or trade it completely wrong. It's called the doji. And it is, without question, the most misunderstood candlestick in all of technical analysis. Beginners see it and think, oh, the market is confused, that's a reversal signal, and then they trade it, everywhere, in every context, and they lose. But here's the thing, when you understand what a doji actually means, and more importantly, where it means something, it becomes one of the most powerful early warning signals you can have. Because the doji doesn't just tell you the market is undecided, it tells you that one side is losing control, and if you know which side, and you know where it happened, you can position yourself before the crowd even realizes the trend is changing. In this lesson, I'm going to show you the 4 types of doji, what each one really means, where to look for them, and how to trade them with confidence. By the end, you'll see this candle on every chart you open, and you'll know exactly when to pay attention and when to walk away. Let's start with the basics. A doji is a candlestick where the open and the close are virtually the same price. The body is tiny, sometimes just a thin line, but the wicks can be long, short, or asymmetric, and those wicks tell the whole story. Think about what has to happen during a trading session for the open and close to end up at the same price. Buyers pushed price up, sellers pushed price down, and by the end of the session, neither side won. They fought to a draw. That's what a doji represents, a stalemate. A moment of indecision, a pause in the action where the market is catching its breath and deciding what to do next. Now, indecision by itself isn't that useful. The market is indecisive all the time. But indecision after a strong move, after a sustained trend, after price has been sprinting in one direction, that's a completely different story. That means the side that was in control is losing its grip, and when one side starts losing momentum, the other side senses an opportunity. The doji is the market's version of a yellow traffic light. It doesn't tell you to stop. It doesn't tell you to go. It tells you to pay attention because something is about to change. And the type of doji you see, combined with where it appears, tells you what's likely coming next. The standard doji is the simplest version, small or non-existent body, with wicks extending roughly equally above and below. It looks like a plus sign on the chart. This is the purest expression of indecision. Buyers and sellers traded blows evenly throughout the session, and neither side came out on top. The wicks show that price moved in both directions, but the close came right back to where it started, where it matters. A standard doji at the top of an uptrend suggests that buyers, who have been in control, are running out of steam. They're pushing price up, but sellers are pushing back just as hard. If the next candle is bearish, that's your signal that the tide may be turning. The same logic applies at the bottom of a downtrend. Sellers have been dominant, but a doji tells you buyers are starting to fight back. If the next candle is bullish, that's your early reversal signal. In the middle of a range or during choppy price action, a standard doji means nothing. The market is already indecisive, so a candle showing indecision doesn't add any new information. Location, as always, is everything. The Gravestone Doji is the bearish member of the doji family, and its name is fitting because when you see it at the right place on the chart, it can mark the death of an uptrend. Here's what it looks like. The open and close are both near the low of the session. There's a long upper wick and virtually no lower wick. The candle looks like an upside-down T. Think about what happened during this session. At the open, buyers immediately took control. They pushed price up aggressively throughout the session, creating that long upper wick. It looked like the uptrend was going to continue. But then, at some point, sellers stepped in hard. They pushed price all the way back down to where it opened. By the close, every buyer who entered during the session was underwater. That long upper wick is a visual record of failure. Buyers tried to push higher. They had their chance. And they failed. Completely. That's rejection. And at the top of an uptrend, after a sustained move higher, that rejection is a powerful warning signal. If you remember the shooting star from Lesson 4, the Gravestone Doji is similar, but even more dramatic. With a shooting star, there's still a small body, meaning one side had a slight edge. With a Gravestone Doji, the open and close are the same. Nobody won. After buyers tried that hard and couldn't close any higher, you know they're exhausted. How to trade it? Wait for the next candle. If it's red and closes below the Gravestone Doji's low, enter short. Stop above the top of the upper wick. Target 2 times risk or the nearest support level. The Dragonfly Doji is the bullish counterpart. Mirror image of the Gravestone. The open and close are both near the high of the session. There's a long lower wick and virtually no upper wick. It looks like a capital T. Here's the story it tells. At the open, sellers took control. They pushed price down hard, creating that long lower wick. It looked like the downtrend was accelerating. But then buyers stepped in and fought back. They pushed price all the way back up to where it opened. By the close, the entire session's selling had been erased. That long lower wick represents seller exhaustion. Sellers gave it everything they had. They pushed price to the session's low, and buyers completely recovered. That's a strong signal that selling pressure is drying up. At the bottom of a downtrend, after price has been falling for days or weeks, a Dragonfly Doji is a powerful early reversal signal. It doesn't guarantee a reversal, but it tells you that the dynamic is shifting. Sellers are losing their edge. If you remember the hammer from lesson 3, the Dragonfly Doji is the same idea but taken to the extreme. The hammer has a small body. The Dragonfly has essentially no body. Both tell the same story. Sellers tried and failed. How to trade it? Wait for bullish confirmation the next session. If the next candle is green and closes above the Dragonfly Doji's high, enter long. Stop below the bottom of the lower wick. Target 2 times risk or the nearest resistance. Quick pause. If you're leveling up in the markets, you might be leveling up in your career too. Need a resume that actually gets callbacks? Check out Resume Zenith. Professional resumes, built fast. Link in the description. Alright, hit that like button, subscribe if you haven't already, and tap the bell so you never miss a lesson. Let's keep going. The long-legged doji is the most volatile version, and it tells a story of intense battle. Both the upper wick and the lower wick are very long, and the tiny body sits right in the middle. This candle says, chaos. Buyers pushed price way up, sellers pushed price way down, and at the end of it all, nobody won. The session saw massive swings in both directions, but the close ended up right where it started. The long-legged doji represents extreme uncertainty. The market is highly conflicted. Big players are making big moves in both directions. It's like two heavyweight fighters both landing huge punches but neither one going down. Where it matters, at the top of a strong uptrend, a long-legged doji tells you the bulls are losing their unanimous conviction. The fact that sellers could push price down so far, even temporarily, means the trend is under serious pressure. At the bottom of a strong downtrend, same logic in reverse. Buyers pushed back hard enough to create that long lower wick, which means selling pressure isn't as one-sided as it used to be. The long-legged doji is harder to trade than the Gravestone or Dragonfly because it's less directional. The best approach is to let the next candle break above or below the doji's range to determine direction. If the next candle breaks above the doji's high, that's bullish. Below the low, bearish. Use the opposite end as your stop. Now let me tell you where beginners get this completely wrong, because the doji is one of the most overtraded candles in technical analysis. The mistake is simple: trading every doji you see. Beginners learn what a doji looks like, and suddenly they see reversal signals everywhere. They spot a doji in the middle of a range and think a big move is coming. They see one during choppy price action and enter a trade. They find one in the middle of a strong trend and bet against the trend. All of those are losing plays. Here's why. A doji in the middle of a range is meaningless. The market is already going sideways, already undecided. A candle showing indecision in an already indecisive market adds zero new information. A doji during choppy price action is noise. The chart is a mess. You have no context to interpret the signal. A doji in the middle of a strong trend, with no support or resistance level nearby, is just a brief pause. The trend catches its breath for one session and then continues. If you bet against the trend because of one doji, you're going to get run over. The only dojis worth paying attention to are the ones that form at meaningful locations after significant moves. At the top of an extended uptrend, at resistance. At the bottom of an extended downtrend, at support. That's where the doji actually signals a potential shift in power. Remember the Confluence rule from lesson 6? Market structure plus support or resistance plus candlestick pattern. The doji is the pattern, but without the first two, it's just a candle on a chart. So, let's put together the complete professional approach to trading the doji, step by step. Step 1. Identify the market structure using the 30-second chart read from lesson 5. Is it trending? Ranging? Choppy? If it's choppy, stop. No trade. If it's ranging, you can look for dojis at the edges, at support or resistance. If it's trending, you're looking for dojis at the end of the trend, at key levels. Step 2. Find your support or resistance level from Lesson 6. Is price at a significant level? A zone where price has reacted before? If yes, continue. If no, ignore the doji. Step 3. Identify the doji type. Is it a gravestone at resistance? That's bearish. A dragonfly at support? That's bullish. A standard or long-legged doji? Wait for the next candle to confirm direction. Step 4. Wait for confirmation. This is the step that separates professionals from amateurs. Never trade a doji on its own. Always wait for the next candle to confirm the signal. A doji followed by a strong candle in the expected direction is a confirmed setup. A doji followed by a candle that goes the wrong way means the signal was false, and you saved money by waiting. Step 5. Set your entry, stop, and target. Entry on the break of the confirmation candle. Stop on the other side of the doji's range. Target 2 times risk or the next major level. This 5-step process filters out 90% of bad doji trades. The ones that remain are high probability setups with defined risk and a clear plan. Homework time. Pull up TradingView. It's free. Open any 4 charts, daily time frame. For each chart, I want you to find one doji, any type. Then answer these questions. Question 1. Where on the chart did it form? Top of a trend? Bottom, middle, at support, at resistance, in a range? Question 2. What type of doji is it? Standard, gravestone, dragonfly, long-legged? Question 3. What happened on the next candle? Did it confirm a reversal? Or did the trend continue? Question 4. If you had traded this doji using the 5-step process, would it have been a valid setup? Would you have entered? Where would your stop have been? Your target? Do this for 4 charts, and by the end, you'll have trained your eye to distinguish meaningful dojis from noise. That's a skill that will pay dividends for your entire trading career. And as always, I've put everything from this lesson into a free cheat sheet. All 4 doji types, where they work, the 5-step trading process, and common mistakes to avoid. Go to candlelogictrading.com and drop your email. I'll send it straight to your inbox. Next lesson, we're getting tactical. We've learned patterns, market structure, support and resistance, and the doji. Now it's time to put it all together into actual trade plans. Lesson 8. Entry and exit rules. How to plan a trade. When to enter, where to set your stop, and how to decide your target. No more guessing, no more winging it. New lessons drop every Sunday, Tuesday, and Thursday. Hit that like button, subscribe if you haven't already, and tap the bell so you never miss a lesson. I'll see you in the next one. This content is for educational purposes only and does not constitute financial advice. Trading involves significant risk. Always do your own research and consult a qualified financial advisor before making any investment decisions.